I'm Kenny Gott, Certified Financial Planner Consultant and President at Pycheck & Associates in Springfield, Missouri. Clients love our recession reserve concept because it helps them worry less about the stock markets, or not at all. Meet with us and we'll walk you through it for your own investments, maybe help you sleep better. This is a centerpiece of my book, Bottom Line Financial Planning, Manage Risk and Fund the Good Life, Your Whole Life. We'll give you a free copy when you meet with us. Short of an apocalypse, there are really only two ways to lose money in the stock market. Number one, you put too much money into a single company stock and that company goes belly up. So don't let that happen. Diversify across the markets. With no more than 5% in any one stock, or even better, diversify across the whole market with mutual funds or ETFs. Baskets of hundreds or thousands of stocks, so you don't worry about any individual stock in there. You get the performance of the overall stock market minus expenses. Most of you are probably already doing that. What we want to talk about here is the second way to lose money in the stock market, and that is selling for less than you paid. You invest, the markets drop, and you sell for a loss. When people worry about the stock market, this is what they're actually worried about, whether they realize it or not. So let's say you have $1 million, half in stock funds, half in bond funds, and cash. Pretty typical 50-50 moderate mix. So the stock market drops 30%, and all of a sudden, the stock side is only worth $350,000 instead of $500,000. Bonds are pretty stable, not a lot of drama there, but now your total is $850,000 instead of $1 million. So it feels like you lost $150,000, right? But if you don't sell, if you leave the stock side alone, eventually it'll recover and then you're back up around where you started. But here's the problem. Sometimes you do need to sell part of an account. Why? Well, some people sell out of fear. They panic. But again, if you sell stocks when they're down, you're just locking in real losses. So don't sell out of panic. Having a good advisor can help with that, maybe talk you down from that ledge, and this recession reserve idea can really help with that too, as you'll see. But the other reason people sell is to raise cash. Maybe you're retired, you need some money each month to supplement your Social Security, or you need a big car repair, or you need money for a vacation. So when markets drop, how do you avoid selling stock funds to raise the cash you need? Well, if your account looks like this, with the stock side down 30% like this, you tell me. You want to leave the stock side alone, so just raise cash from the fixed side, right? Sell some of the bond funds if there's not already enough cash there. Any decent investment advisor would do that. Most amateur investors would do that. The recession reserve strategy just takes this common sense idea and custom fits it to your withdrawal needs, so we can plan for those stock market downturns. Now, this is complicated by the fact that no one knows when stock market downturns will happen. This has been studied for decades, and it turns out nobody can consistently predict the markets either direction, up or down. And don't let anybody tell you they can. But fortunately, you don't need to jump in and out of the stock market for it to grow your money better than anything over the long run. Just get in and stay in. Companies usually find a way to profit. In fact, the stock market is up about 75% of the time historically, so your stock holdings will grow over the long run. So, step one to building your recession reserve is to assume the next recession starts tomorrow. If you assume this every day, one day you will be right. Step two is to choose your recession reserve period, the time frame for the withdrawals you're trying to protect. Now here's how to approach that. Through 28 market slumps from the Great Depression through the 2008 recession, it took an average of 3.3 years for the purchasing value of stocks to drop, hit bottom, and then come back all the way up to what they were worth before. And that's adjusting for inflation and reinvesting stock dividends. The 2008 recession took 5.4 years. In only 4 of those 28 downturns did it take more than 6 years. Now we can use any time frame you want. For most clients, a 5-year recession reserve period makes sense. So, step 3, how much cash will you need from the account during your recession reserve period? This is the dollar amount you need to try to protect from downturns. So here's an example. Say you need $4,166.67 per month to supplement your Social Security. A nice round number, right? Times 12 months is $50,000 per year. So that is a nice round number for this example. How long is your recession reserve period? Let's use 5 years. $50,000 a year for 5 years is $250,000. That's your recession reserve. This is how much you need to protect in this example. In something other than stock funds, something pretty stable like bond funds or fixed interest products. So when the stock market drops significantly, that's where we raise your cash. So we're leaving the stocks alone, so you quit worrying about losing money, because you don't lose money if you don't sell low. Now, whether withdrawing $50,000 a year is sustainable or not is another conversation. If all they have is $500,000, withdrawing $50,000 per year is probably not realistic. Now, this is another reason you need a financial planner like us, for example, to help you figure that part out. Now, notice your recession reserve is not a percentage. It's a dollar amount. It's not some rule of thumb about your stock percentage at age 40 or 65 or 80. In this example, the recession reserve is $250,000. And that's whether this investor has $1 million or $100 million and whatever their age. So, for example, that would be 25% of $1 million. The other 75% is in stocks growing for the long term. If instead you have $750,000, then the recession reserve is 1/3 of the account, 2/3 is in stocks. Now, this is very important. This doesn't mean you should have 2/3 of the account in stocks in this example. It just means you shouldn't have more than 2/3 in stocks. You want to protect at least $250,000. Now, maybe you'd really like to protect more than that, and that's fine as long as you first think through the fact that the more you have in stable holdings, the less long-term growth you get. So you'll also want us to help you figure out the overall rate of annual growth that you need to get all the way through retirement in good shape and planning for the amount you want to leave for the kids, church, charities, and so on. So each year, figuring out how much your recession reserve should be is pretty easy. Figuring out how much more you want to protect and how much long-term growth you can afford to give up for that extra stability, well, that's why our clients need us, to help find that sweet spot. And that's not always simple. And we may need to do a retirement analysis to figure out that part. For example, if someone is 100% in the stock market because they have no idea how much growth they really need, but it's giving them heartburn, if we do a retirement analysis and it turns out they only really need 5% growth per year, well, then we can maybe dial down that stock percentage, create their recession reserve, and maybe even put more in the conservative side and still be able to get 5% growth and, cure that heartburn. On the other end of the spectrum, if an investor wants to stick with a moderate 50-50 mix, say, half stocks, half fixed, but let's say they really need 6.5% average annual growth to get through retirement, a 50-50 mix might be cutting it close, and based on historical averages, it might not work. If they can bump up the stock portion a little and still keep their recession reserve the right size, well, they may have a better shot at getting the growth they need. And now maybe you can handle a little more on the stock side if you need to, now that you have a strategy. You know right now what you're going to do when the markets drop. So you don't panic, you don't worry. Every year you recalculate your recession reserve for the next 5 years or whatever your recession reserve period is. So every year you're reminding yourself of this plan. And this trains your emotions to care less about the stock market volatility or not at all. So you can enjoy life, enjoy your hard-earned money, because it's the things you do with that money, the trips you take with loved ones, the toys you buy that helps you live the good life. Here's our number. Call for your complimentary consultation and we'll help you figure out your recession reserve. We'll look at your investments to see if maybe we can help you invest more efficiently. Do a retirement analysis if needed to see how much growth you need and build an investment mix that gets you there so you can live the good life. Because it's your future. You earned it. Thanks for watching.